Alright, for this video I wanted to cover how to prepare the IRS Form 4797, but specifically we want to cover how to report the sale of rental real estate property. So the Form 4797 is used to report the sale of almost any kind of property that's being used in a trade or business. And so specifically on this one I want to cover rental real estate. So what I've got here are a couple of slides that cover the rules and the fact patterns. So we've got 4. So we're going to cover 3 fact patterns you can see at the bottom here. And then I also have the 4797 examples. So I've got 1 for each fact pattern. So we'll walk through how each of these work. So just some of the high level basic here. So when you have real property, so whether it's single family homes, so like residential rental property, apartments, or commercial property, if you are placing this into service to rent out to tenants, that is treated as property being used in that trade or business. So it's a rental real estate business. Now, the sale of that property, it's important to differentiate between the sale of real property used in a trade or business versus the sale of other assets, right? So different tax rules apply when we buy and sell investment property, or it's inventory, or even personal use property, right? So there's separate rules around if you buy something and use it for personal use, so it's not being deployed in a trade or business, there are different tax rules that apply. So the relevant code sections that we're really focusing on here today are 1250, 1245, and 1231. So 1250 covers depreciable realty, so the sale of real property. 1245 covers the sale of personal property. So personal property is basically anything that's not real property. So it's broken out further into tangible and intangible. Intangible property are things like computer equipment, furniture, vehicles, things like that. And then section 1231 is what we're really going to focus on as well, and this is our friend, right? So section 1231 has special rules for the sale of property that's used in a trade or business, and you hold it for more than 1 year before you sell it. Okay, so generally speaking, when we have 1231 transactions, the gains, if they qualify, are treated as long-term capital gains, right? And that's a good thing because long-term has a lower tax rate. But if we happen to sell the property at a loss, then we can treat it as an ordinary loss, right? And so notice here how you kind of get the best of both worlds, right? If we make money, it's a long-term capital gain. But if we lose money, we can treat it as an ordinary loss, which is good because ordinary losses don't have the same kind of capital loss limitations like capital losses do. We can use our ordinary losses to offset other types of ordinary income. So it's generally, a good thing to have this. Now, what's important to note, and we will talk about this later, the non-recaptured 1231 losses. So if you have a loss, and this is, let's say 1250 property qualifies under section 1231 because we held it more than a year, but we took a loss, you get the ordinary loss treatment, but you have to track those losses going forward. And the reason for that is if in subsequent years you have 1231 gains, you have to recapture some of those net 1231 losses from the prior period. Okay, so the IRS is giving you the benefit here in the first year, but what they are saying is, hey, look, we're going to give you this ordinary loss treatment in the year you sell it, but if in the event down the road you have another property that you sell and you want to claim this 1231 long-term capital gain treatment, you're not going to get it. Well, you will get it, but there might be a recapture portion that is ordinary in nature. Okay, so we'll touch on that later when we get to a fact pattern that might cover that. So, okay, so here are the 3 fact patterns we're going to cover in the video. Sale of property held more than a year for a gain. Sale of property held for more than a year, but we take a loss on it. And then lastly, the sale of a property that we held for less than a year, okay, and we made a gain on it. So what do all these look like? So let's look at the first fact pattern here. So this is our sale of property long-term, and we took a gain on it. So our first fact pattern, let me go to the slide. We've got John here. He bought this single-family home in 2018, and he paid $200,000 for it. And he put it into service as a rental property for the next few years. Now, in 2021, he decides to sell it, and he gets $250K out of it. Okay, so a nice little return there. The cost of sale were $2,000. And during the year, he had no other sales, dispositions, and none of these carry forward amounts related to 1231 or 1250 property. Okay, so what are the rules here, and what's that going to look like when we actually look at the 4797? So the real property is classified as 1250 property, and it was held for more than a year, so he gets the 1231 gain treatment, or the 1231 treatment first, and then we figure out gain, loss, and whether it's capital or ordinary. Now, again, so the sale of the 1231 property, he's going to make a gain on this. And so if he does, then he's going to get that long-term capital gain rate. But again, he's got to be mindful of if he had any prior year loss carryovers from the prior 5 years related to 1231, so those non-recaptured amounts. Again, in this example, we've said that he has no other sales, dispositions, or any of these carry forward amounts, so that's not going to be relevant to him. But if you want more information on that, I will be putting up some separate videos that cover that issue, so just stay tuned for those. So where do we report the sale? It's going to go in Part 3 of the 4797, and then ultimately it's going to flow up to Part 1, and then on to Schedule D. Okay, so let's look at the 4797 here and jump into it. Okay, so 4797 is 2 pages, 3 parts. Right, so Part 1 we use to report the sale or exchange of property using a trade or business if it's held more than a year. Okay, so that's Part 1 collectively here. Now, if we have property that is sold for a gain and we held it for more than a year, that information is generally going to be reported down here in Part 3. Okay, so Part 3, you can see the title here, Gain from the Disposition of Property. That's 1245, 1250, 52, 54, and 55. So we have a gain from the sale of our property under 1250 because it's real property, so we report it here. When we take losses on 1250 property, the entry goes up here in Part 1, okay? And so we'll see that later on the last example. Okay, so if we start here with Part 3, we have the gain from the sale of the property, enter the description of the property, the date we acquired it, the date we sold it, and then here's the sales information. So the gross sale price, right, $250,000, that was the sale price. Our cost basis, you remember, was $200,000 initially, and then $2,000 for expense of sale, right? And so line 21 wants us to add those two amounts together. So we get our $202,000 total cost plus expense of sale amount. Now here's the depreciation element, right? So line 22, we report the depreciation that was allowed or allowable that we've taken over the years. So this figure here, $17,728, that's the amount of the depreciation that John took on the property from the date he placed it into service up until the date of sale. So if we look at the depreciation schedule just very quickly, you can see here how we've broken out the building, $150, the land, $50K. Remember, land is not depreciable, so we're only depreciating the $150. And then the accumulated amounts down here. So the total depreciation, that's the number we just saw up on the page 2, the 4797. That is the total accumulated depreciation all the way up until date of sale. So the $5,228, this is the depreciation we're taking for 2021. And then the difference between the two of those, that's what we took in the prior period. Okay. So after we enter that depreciation there, and why is that important? It's important because depreciation expense reduces your cost basis to arrive at your adjusted basis. When we calculate our gain on the disposition, it's our sale price over the adjusted basis of the asset. Okay, it's not our original cost. So you'll see here that our total gain, subtract line 23, adjusted cost basis, from line 20, the gross sale price, is $65,728. So if John was initially thinking, oh, well, I bought it for $200, sold it for $250, I've got some expenses, oh, my gain is $48,000. That's not the case, right? Because of the depreciation recapture. So the $17,728 reduces your basis, and so that effectively increases your gain on the sale of the property. A lot of real estate investors are really shocked to hear that, right? Everybody thinks, well, I can just depreciate this thing all the way down to zero, and then when I sell it, basically my gain is just whatever I paid for it minus the cost. And it's just not true, right? Depreciation has to be tracked for this reason, right? It adjusts your basis downward every time you depreciate an asset. Okay, so we've got our adjusted basis and our total gain there. Now these sections down here, 1245, it's not 1245 property, right? It's a real estate, it's not personal property, and it's neither of these, right? It's not 1252, 54, 55. This section, part 26, is relevant, right? So if section 1250 property, well, the answer is yes, right? So we do have 1250 property. If straight line depreciation was used, enter 0 on line 26, except for corporations subject to section 291. So we use straight line depreciation, all right? So this is a property that was placed in service in 2018. It's residential real estate, so it's being depreciated over 27 and a half years. So if I jump down to the depreciation schedule, right? So we're straight line, right? Mid-month convention and a 27 and a half life period. The NDA is a reference to the land here, right? So remember, land is non-deductible, so you can't depreciate. It's a non-depreciable asset, okay? So 27 and a half year life, straight line method. So because we use the straight line method, we can enter 0 and we don't have to do anything further here. So under what circumstances might you have to fill this out? If you have property that was placed into service before 1986 and you likely use an accelerated depreciation method, then you might have some issues here, right? And so what they're doing here is the capital gain, the depreciation recapture that we have is just going to be long-term. But if you have accelerated depreciation in prior years and you have a 1250 recapture amount, if you took accelerated amounts, you might have an ordinary amount of depreciation recapture. So I'm not going to cover that kind of example in this video. I will put a video up that addresses that issue. So if you want to learn more about that, check that one out. But high level, if you're buying a property after 1986, this section is going to be irrelevant to you. Quite frankly, you're not going to need this. You're not going to see it, and that's because all the real property placed into service, in the last few decades, is just being depreciated under the straight line method. So you don't have any of this accelerated depreciation. Okay, so once we have our total gain at the bottom here, $65,728. That number flows up to page 1, line 6, right? So line 6, it says put the gain, if any, from line 32. Right, so there's our 65,728 number, and then in this section here, it gives us some nice information about where to report the amount. Right, so individuals, we enter the gain from line 7 is a long-term capital gain on Schedule D. So if we jump up to Schedule D here, we can see the capital gains and loss schedule, and then down here on line 11, there's our gain amount. So in this example, the sale of the residential real estate, the rental property, at a gain, an overall gain, is a 1231 gain, right? And so all of it is treated as net long-term capital gain. So we get that nice low long-term capital gain tax rate. So it's not short-term and it's not going to be ordinary. So this is what we're after, right? So this is more or less how you would fill that out if you sold the property during the year. Now, you can see up here, Schedule E, you would fill this out as you normally do. So here's our the rental income or loss for the year up until the date it was sold, right? So this you should be familiar with, right? You're entering your rent received during the year, all the expenses. None of the gain or loss information of the property is reported on this schedule, right? This is just the income and expense, depreciation expense for the period, for that tax period. The sale of the assets itself is reported on 4797 and then elsewhere on the return. Okay, so now let's go over to the second example. In this fact pattern, what we're going to cover is, again, we have a long-term sale, but we're going to take a loss on it. So now we're going to see how 1231 property, when we take a loss, is to our benefit. Okay, so the fact pattern stays mostly the same except for the sale amounts, right? So bought this home in 2018, placed it in a rental service, paid $200K for it, but now he sells it for $175,000. So he paid $200, sold it for $175, cost of sale are $2,000 still, and again, assuming none of these other carry forwards amounts from prior years. So similar things apply here, right? It's just a different in how the loss is being reported. So the real property is still 1250 property. It's held to more than a year, so it's going to qualify for Section 1231 treatment, right? So that's good. We want that. Now, the sale of 1250 property under 1231 at a loss is going to be ordinary, right? Now, this is good because we can use this to offset other ordinary income. So that's also a nice plus. So where's the sale information reported? It's going to be reported in Part 1, 4797, and then ultimately it's going to flow through to line 4, Schedule 1 on the 1040. So we'll take a look at that too. Now the losses, again, touching on this again with the 1231. Well, when you have 1231 losses, ordinary, that are taken in a tax year, you need to continue to track those going forward because you have what's referred to as non-recaptured 1231 losses. So again, if in the future year John had another property, sold it, and he had the 1231 long-term gain, he would have a non-recaptured 1231 amount that he would have to offset first. So there would be a combination of ordinary income recapture, and then the rest would be long-term capital gain. Okay, so let's look at the example 4797. Okay, so here, remember, so Part 3 we used to report if we had gains on the sale of the property, right? So now you see we don't even have Part 3 anymore because we have no gains on the sale of that 1250 property. We have losses. So when we have property used that's held for more than a year and we sell it for a loss, we enter the information here in Part 1 on line 2. So we have the property address, date acquired and sold, the cost basis, right? So there's the $202,000, $200,000 costs, $2,000 in selling expenses. The depreciation that was allowed or allowable is the same, $17,728. And now we note here our gross sale price isn't $250 anymore, it's $175. So we have a loss on the sale, right? So our adjusted basis is calculated the same too, right? We had $202,000 minus $17,724 or $727, right? So our adjusted basis is roughly $184,000. And so when we subtract the two out, our gross sale price was lower than our adjusted basis. So that's why we have a loss. Now, because this is 1231 property or 1250 property, getting the application of the 1231 gain loss rules, we can treat this loss as ordinary, right? So combine all these amounts. Here we have it listed here on line 7. And then again, it asks us to report, depending on what type the loss amount is, again, if it's long-term capital gain, it goes in Schedule D. If it's an ordinary loss, it flows through to Schedule 1. So we can see here it asks us, if line 7 is 0 or less, enter the amount here and then on line 11. And so if we jump down here to line 11, it asks us here all the way down at the bottom in line 18, right? If any, on line 18, enter here and on Schedule 1, Form 1040, Part 1, line 4, right? So that $9,273 loss, that is ultimately flowing all the way up here to Schedule 1. And we can see here Schedule 1 with the 1040 for additional income and expense. There's our loss item. So Part 1, line 4, other gains or losses coming from the 4797. We have our minus $9,273, okay? So that's the big difference, right? I mean, there's a huge difference between having an ordinary loss flowing through to your return versus capital loss or capital loss or capital gain or any other item, right? I mean, ordinary losses are very, very good, right? Because they can offset all these other types of additional income and without really much limitation. Okay, so that covers that example. So let's now move over to the very last one. So this is the last fact pattern here. We have John, again, he owns a single family home, but now, because it's short term, we had to change the buy and sale dates a bit. So we bought this home in December 2020. Again, he's renting it out, paid $200K for it. Now he sells it in September 2021 for $250,000. So now he's owned it less than a year, right? It's about 10 months he's owned it. Cost of sale are $2,000. John has no other carry forwards or any amounts like this. Now, the property is still Section 1250 property, right? So it's still real estate that's depreciable. But because it's not being held for more than 1 year, he's not going to get this preferential 1231 treatment. When you sell property used in a trade or business for 1 year or less, you're going to get ordinary treatment. So it's going to be ordinary income. If it's a gain, it's going to be ordinary loss if it's a loss. Okay, that's just the way it works. Now, where's the sale information reported? So the sale information is going to be reported in Part 2 of the 4797, and then the gain is ultimately going to flow through to line 4 of Schedule 1, so the same place we were just at for the losses. And again, the gain here is going to be treated as ordinary gain, subject to ordinary marginal tax rates, so it's taxed at the highest level. So if we look at this example, so we have our same 4797 here. Part 1 is blank, right, because this is property. This is only for property that was held for more than a year. That's not our case now, so we're going down to Part 2. Part 2, ordinary gains and losses not included on lines 11 through 16, and this includes property held 1 year or less, right? So that's us. This is where we live. So enter the address of the property or whatever you've called the property within your return. The purchase date, the sale date, the gross sale price is $250. The cost basis plus expenses of sale, right? There's that $202,000, and then $4,091 is the amount of depreciation accumulated up until the date of sale. So that amount includes the piece that was from the prior year. So if we look at our depreciation schedule here, we placed the asset into service on December 3rd last year. Again, straight line method, 27.5-year period, mid-month convention for the date it was placed in service and sold. So the accumulated depreciation, there's that $4,091 number. The amount for the current year is $3,864, and then the little piece that's the difference there, that was the portion of the depreciation from December of the prior period. Okay, so if we go back up to the 4797 again, so we've got all our items entered here. And if we work all our way across to compute whatever the gain or loss is, we've got our $52,091 number. This entire amount is going to be ordinary gain, right? So $52,091, again, it's flowing into the same place that we were at before, right? So Schedule 1, Part 1, line 4, right? So if we jump up here to the additional income and expense, there it is, $52,091. Okay? So that covers the 3 examples here. I would recommend, I'm going to post videos that will cover more of these recapture issues, so stay tuned for those. But if you are, again, looking for just a simple example as to fill out these forms for the sale of property that was used in real estate, I think these examples should cover most of what you would see in practice. So I hope it was helpful. And of course, if you have any questions or comments, leave a comment below. Happy to answer any I can, and I look forward to seeing you again on the next video. Thanks and take care.